Title: The Financial Advice Keeping You Broke, the Big Five Surgery, the Latte Lie. I want to begin with a confession. I am tired of hearing the same financial advice repeated for the last 30 years. You've heard it on every morning talk show. You've seen it on the covers of every cheap personal finance book. They tell you that the reason you aren't a millionaire is because of your morning coffee. They tell you to skip the $5 latte, cancel your $10 Netflix subscription, and stop buying the expensive avocado toast. They call this financial discipline. I call it a distraction. In my decades of observing the markets, I have never met a single person who became wealthy by saving $5 a day on caffeine. Not one. In fact, focusing on the small stuff is often the very thing that keeps you broke. It gives you a false sense of accomplishment. While the real predators, the vampire expenses, are eating your future in the background while you sleep. Wealth is not decided by the 100 small decisions you make every month. It is decided by the 5 big ones. I recently spoke with a couple, let's call them Sarah and David. They were in their late 40s, stressed, and felt like they were running on a treadmill that was only getting faster. They tracked every cent. They clipped coupons. They hadn't been to a movie theater in 3 years because they thought that $30 would be better spent in a savings account. Yet, when we looked at their net worth, it was stagnant. When we performed surgery on their Big Five, the reason was obvious. They were stressing over a $40 monthly gym membership while they were overpaying for their home by $2,500 a month. They were latte disciplined but lifestyle broke. As we move toward 2026, the economic rules have fundamentally shifted. We are entering a period of sticky inflation where the purchasing power of your happiness decays faster than the dollar itself. You cannot afford to play small. You need to stop worrying about the rounding errors and start performing surgery on the big decisions that dictate your retirement date. Today, we are going to look at the only 5 expenses that actually matter: housing, transportation, healthcare, family obligations, and the hedonic treadmill. If you get these 5 right, you can buy all the lattes you want. If you get them wrong, no amount of budgeting will save you from a level 2 retirement trap. Let's begin the surgery. Part 2, the equity prison, housing. The first and largest expense in your life is housing. This is where most people lose the financial war before the first battle is even fought. The old rule was simple. Buy the biggest house you can qualify for. Real estate always goes up, right? This advice has turned millions of Americans into what I call the house-poor elite. Robert Kiyosaki was the first to punch a hole in this lie. He famously said, "Your house is not an asset. It is a liability." Why? Because in strict financial terms, an asset puts money in your pocket and a liability takes money out. Unless you have tenants in your basement paying you rent, your house is a liability. It is a negative yielding asset. If you are a 25-year-old trying to build wealth, your goal should be to minimize housing costs to maximize your investment seed. Every dollar you lock into a mortgage is a dollar that isn't compounding at 10% in the market. But if you are a 60-year-old approaching retirement, your goal is even more critical. You must unlock dead equity. Let's look at the brutal math. Most people look at their mortgage payment and think that is the only cost. It isn't. You have property taxes, which are currently increasing at double the rate of inflation in many states. You have insurance premiums, which have spiked 20% to 30% in the last year alone as insurers react to global climate risks. Then you have maintenance, which any honest homeowner knows is at least 1% of the home's value every single year. If you own a $900,000 home, it is costing you roughly $30,000 a year just to hold the keys before you pay a single dollar of interest to the bank. For the older generation, the big house is an equity prison. You might have $600,000 in equity locked in your walls. That money is earning you 0%. In fact, it is costing you $2,500 a month in carrying costs to maintain rooms that your children haven't slept in for a decade. If you downsized, if you moved from that 3,500 square foot empty nest to a 1,500 square foot comfortable condo, you wouldn't just lower your utility bills. You would unlock that $600,000. If you put that $600,000 into the three-pillar portfolio we discussed in our last video, yielding a conservative 5.27%, that is $31,620 a year in pure cash flow. Look at the Lynch inversion here. Instead of paying $30,000 a year to live in a museum of your past, you are earning $31,000 a year to fund your future. That one decision is worth more than 40 years of skipping lattes. Be ruthless. If you have rooms you haven't stepped in for a month, you are paying for an ego-driven liability masquerading as a success symbol. Part 3. The depreciation bomb, transportation. The second expense that keeps you broke is transportation, specifically the new car trap. We are a society that uses our vehicles to signal status to strangers we don't even like. We want the BMW, the Tesla, or the high-trim pickup truck that costs more than a starter home did in 1990. But as someone famous said, invest in what you know. And what we know about cars is that they are the most efficient wealth destruction tools ever invented. A car is a depreciation bomb. The moment you drive it off the lot, you lose 15% of your wealth. Within 5 years, you have lost 60%. But the real damage isn't just the sticker price, it's the opportunity cost. In late 2025, the average new car payment has crossed $750 a month. When you add in insurance, which is 15% higher for new vehicles, registration, and the specialized maintenance these complex machines require, the average American is spending over $1,100 a month on a piece of metal that spends 95% of its life sitting in a driveway. Let's run the Lynch inversion math for the 35-year-old viewer. If you take that $1,100 a month and instead of paying for a depreciating car, you invest it into a basic S&P 500 index fund. Over 10 years, at an 8% return, that $1,100 a month turns into $198,000. Over 20 years, it turns into $620,000. By the time you reach 65, that one decision, driving a reliable 5-year-old used car instead of a new luxury one every 3 years, is the difference between retiring with an extra $1 million or working until you're 75. For my older audience, why do you have 2 cars? If you are retired or semi-retired, do you really need 2 sets of insurance premiums, 2 sets of registration fees, 2 sets of tires rotting in the sun, selling that second vehicle, and using a ride-share service for the few times a month you both need to be in different places is the smartest dividend you can give yourself? Remember the 23-8 rule. Put 20% down, finance for no more than 3 years, and keep the payment under 8% of your income. If you can't hit those numbers, you are buying a toy, not a tool. Wealthy people buy things that go up in value. Broke people buy things that go down in value. Stop trying to look rich while you are actually becoming poor. Part 4. The silent budget killer, healthcare, and the 2026 shift. The third expense is the most terrifying for the 55-plus demographic because it is the only one you cannot budget your way out of once it hits. I'm talking about healthcare. Fidelity's latest estimate for 2025 reveals that a 65-year-old retiring today will spend an average of $172,500 on out-of-pocket medical expenses throughout their retirement. That number is up 4% from last year and shows no signs of slowing down. Most people treat healthcare as an unavoidable tragedy. They wait until they get sick and then pay whatever the bill says. That is reactionary finance. It is the fastest way to trigger a bad start in your sequence of returns, forcing you to sell stocks during a market dip just to pay for a surgery. The wealth architect uses preventative finance. If you are in your 40s or 50s, the best investment you can make isn't a hot stock. It's your health savings account. It is the only triple tax-advantaged account in existence. Tax-free contributions, tax-free growth, and tax-free withdrawals for medical expenses. If you are 50 and you aren't maxing out an health savings account, you are leaving a massive tax-free legacy on the table. In 2025, the contribution limits have increased, and for those over 55, the catch-up provisions are a gift from the IRS that you cannot ignore. But we also need to talk about the 2026 Medicare shock. Headlines are already warning about the new Medicare Part B premium increases. In 2026, standard premiums are jumping nearly 10%, from $185 a month to $202.90. For the average senior, Medicare is going to eat nearly one-third of their entire Social Security raise before they even see the check. This is why you must self-insure the small things. Raise your deductibles on your home and auto insurance. Take those premium savings and put them into your health savings account or a cash wedge. And for those of you under 40, your health is your greatest financial asset. A single chronic illness in your 60s, caused by poor habits in your 30s, can wipe out 30 years of perfect investing. Eat like you're poor now, so you don't have to live like you're poor later. Part 5. The hedonic treadmill, envy versus autonomy. The fourth big expense is not a bill. It is a psychological glitch. It is the hedonic treadmill. This is the silent killer of the high earner. I have met surgeons making $500,000 a year who are living paycheck to paycheck, terrified of a 3-week gap in their income. How is that possible? Because every time their income went up, their definition of normal expanded to meet it. They got a raise, so they upgraded to the country club membership. They got a bonus, so they traded the perfectly good SUV for the one with the massaging seats. They felt successful, so they started flying first class because they earned it. The 1% habit that separates the truly wealthy from the pretend rich is the ability to maintain a static lifestyle while income grows. If you make $70,000 a year and you are happy, and then your income jumps to $120,000, if you can keep living on that $70,000, you have just discovered a $50,000 a year wealth engine. But 99% of people spend that $50,000 on upgrades. And here is the psychological tragedy: the upgrades don't actually make you happier. Science shows that the joy of a new purchase lasts exactly 3 months. After that, the new car feels like a regular car. The bigger house feels like a regular house. But the bills for those upgrades stay high for the next 30 years, Charlie Munger used to say. Envy is a really stupid sin because it's the only one you could never possibly have any fun at. If you are spending money to keep up with your neighbor, you are letting a person you might not even like dictate your retirement date. You are trading your time, the only asset you can never get back, for stuff that will be in a landfill in 10 years. The greatest luxury in the world is not a fancy watch. It is autonomy. It is the ability to wake up and say, I can do whatever I want today. You cannot buy autonomy at a car dealership. You can only buy it by keeping your big 5 expenses low and your cash flow high. Stop being an accumulator of things. Become an architect of time. So, let's wrap this up. Tonight, I want you to go back to your budget. Stop stressing over the latte. Stop feeling guilty about the occasional dinner with your family. Those are rounding errors. They represent maybe 2% of your lifetime wealth. Instead, perform the surgery on the big 5. Number 1, housing. Is your equity earning its keep, or are you living in a negative-yielding museum? Number 2, transportation. Are you driving a depreciation bomb that is stealing your grandchildren's inheritance? Number 3, healthcare. Are you using an health savings account to turn medical costs into a tax-free investment? Number 4, taxes. Are you ignoring the 2026 shifts in Social Security and Medicare premiums? Number 5, lifestyle. Have you stopped the treadmill, or are you still running to keep up with neighbors who are also broke? Perform the surgery. Cut the waste in these 5 areas, and you will find thousands of dollars a month that you didn't know you had. And then take that newly found capital and move it into the 3-pillar portfolio we built in the last video. Move it into real cash-flowing assets that pay you while you sleep. Wealth is not a mystery. It is not about being a genius. It is about inversion. If you avoid the 5 big mistakes that keep everyone else broke, you will eventually wake up rich. It is a mathematical certainty. If you found value in this surgery, subscribe to the channel. We are building a community of investors who focus on what actually matters: